Welcome, audience. Thank you for joining us today. Today, we will talk about the impact of global financial liberalization on emerging markets. Let's have a brief introduction about it. So, financial liberalization refers to the relaxation of financial regulations and the reduction of restrictions on international trade and capital. It is mainly proposed to address the situation in which the financial market is imperfect and thus affects economic development in developing countries. Emerging markets refers to countries with gradually improving market economy systems, high economic growth rates, and greater market development potential. Its main characteristics are low investment, high growth, and high returns, small market size, fast economic growth, demographic dividend, and abundant resources. In the flow of global capital, emerging markets are the intersection of opportunities and risks. They are an important driving force for global economic growth. And then we will look at the historical background of global financial liberalization. So, as we all know, in the 1970s, on the one hand, with the disintegration of the Bretton Woods system, the fixed exchange rate system was no longer able to adapt to the current economic condition. On the other hand, the United States experienced severe cash deflation, with slow economic development and inflation. Inflation and unemployment rose simultaneously. Financial liberalization began to sprout. In the 1980s, the United Kingdom and the United States took the lead in promoting financial liberalization, releasing restrictions on capital flows, and driving the rapid development of global financial markets. At the same time, developing countries and emerging market economies have gradually joined this trend. With the continuous development of financial liberalization, emerging markets began to accelerate the pace of liberalization in the 1990s, such as Asia and Latin America. After the global financial crisis in 2008, the pace of global financial liberalization slowed down. Despite this, the opening up of financial market continues, and some emerging market countries continue to promote the internationalization of capital markets and reduce risks by strengthening financial supervision. And then we talk about main measures of global financial liberalization. We can summarize as follows: capital account liberalization, interest rate liberalization, liberalization of access to financial institutions, liberalization of the interest rate system, opening up of financial markets. So next, we talk about positive impacts on emerging markets as follows. 1. Increased capital influence. Financial liberalization makes it easier for foreign capital to enter emerging markets, providing these economies with a much-needed source of funds. 2. Promote economic growth. Through financial liberalization, emerging markets can better participate in the global economy and trade, driving export growth and technological progress. More open financial markets can also encourage governments and companies to be more transparent and standardized in policies and operations, forming a good market environment, thereby promoting long-term economic growth. 3. Promote financial innovation. Financial liberalization has created a more relaxed environment for financial institutions and stimulated the motivation for innovation. And 4. Expand employment and improve income. Increased capital influence and corporate investment will create a large number of jobs and drive the employment rate of local labor. 5. Promote policy transparency and market norms in order to attract foreign investments. Emerging markets often improve their legal systems and policy transparency, standardize market behavior and financial supervision, thus improve the business environment. So there will be a lot of potential risks and challenges, and then we will discuss about it. First, increase in financial risks. For emerging markets, regardless of the degree of financial liberalization, there will be information asymmetry. 2. Increase short-term volatility in the stock market. After the financial liberalization of emerging markets, a large amount of speculative capital has entered the market. In the short term, if interest rates or exchange rates change, it will cause a linkage effect on the stock market, with large capital outflows or inflows, and increased volatility in the stock market. 3. Capital flight. If the economy or policies of emerging markets is unstable, investors will often withdraw funds in order to avoid risks, causing market financial instability and affecting exchange rate. 4. Exchange rate fluctuations. When a large number of foreign capital invests in emerging markets, the local currency appreciates, which promotes imports while weakening the advantage of exports, which easily leads to a balance of payment deficit. And 5. Bank bankruptcy risk. Financial liberalization has created many lending models. The role of banks is gradually weakening, and they have to maintain operations through low interest rates. Therefore, in order to reduce expenses, banks ignore credit risk concerns when selecting loan targets, lend on a large scale, and bear the burden of high credit risk. 6. Limited independence of monetary policy. There is an impossible triangle in emerging markets with financial liberalization, that is, monetary policy, exchange rate policy, and capital flows cannot be satisfied at the same time. 7. Financial liberalization measures need to be targeted. For emerging markets, the economic conditions of each country are different, and the financial liberalization strategies of developed countries cannot be fully applied. Analyze the stage of development and the overall level of financial development of country for a specific country, and formulate corresponding financial liberalization strategies. 8. Increased poverty. The development of small and medium-sized enterprises is very important to emerging markets, but compared with large enterprises, small and medium-sized enterprises are more susceptible to economic fluctuation. Financial liberalization can easily cause economic fluctuations, and it is difficult for small and medium-sized enterprises to benefit from it. 9. Financial regulatory risks. After financial liberalization, cross-border capital flows, the entry of foreign investment institutions, and new financial products have increased, which has put forward higher requirements for the professional capability and the supervisory methods of regulatory authorities. Regulators in many emerging markets have difficulty adapting quickly. So the following case analysis will be introduced by my teammate.
Okay, next we will explore the impact of financial liberalization on emerging market through two typical cases. First, let's look at the two waves of financial liberalization in Latin America. The first wave occurred in the 1970s and 1980s, mainly in the southern corn countries, such as Chile. These countries implemented measures such as interest rate liberalization, cancellation of target loans, and the reduction of bank reserve ratios. However, after the Mexican debt crisis in 1982, the economies of these countries that relied on foreign capital fell into trouble, showing the potential risks brought by financial liberalization. In contrast, the second wave began in the late 1980s and expanded to the whole of Latin America. The characteristics of this period include privatization of state-owned banks, introduction of foreign banks, and the strengthening of central bank independence. Although this reform attracted a large amount of foreign capital, promoted economic growth, and reduced government intervention, it also exposed problems of immature policies, insufficient supervision, and unstable capital flows. Next, let's look at China's financial liberalization process. China has adopted a step-by-step reform strategy and has gone through multiple stages. From the deregulation of financial markets in the early days of reform and opening up, to the introduction of a market-based exchange rate mechanism in the 1990s, to the acceleration of foreign capital entry in the 2000s. And now China is in a stage of comprehensively deepening reform. The achievements of China's financial liberalization are reflected in the following aspects: promoting economic growth, improving the efficiency of resource allocation, attracting foreign investment inflows, and driving economic development, promoting the internationalization of the RMB. The opening of financial markets has laid the foundation for the use of the RMB in international trade and enhanced its international currency status. Last but not least, modernizing the financial system. Financial liberalization has promoted the development of financial technology and internet finance and improved market efficiency. However, China also faced some challenges: inadequate risk management. Weak early supervision has increased the hidden dangers of financial crises. Information asymmetry, which investors cannot obtain sufficient information, increasing the risk of market volatility. Regulatory lag. The speed of financial innovation is faster than the speed of regulatory adaptation, which increases systemic risks. And to this end, we put forward the following policy recommendations. First, strengthen macroeconomic regulation. Maintain monetary stability and promote sustained economic growth. Improve financial supervision to ensure the health and safety of the market. Then promote financial liberalization step by step to avoid the risks brought about by too fast opening, and combining national conditions with international experience, promote reform and innovation. In summary, whether in Latin America or China, financial liberalization has brought both opportunities and challenges. For emerging markets, finding a balance between openness and risk management is a key to successfully promoting financial liberalization. We must formulate corresponding financial liberalization plans based on specific economic development conditions and continuously improve financial supervision. In general, financial liberalization is an important step for emerging market countries to move forward globalization, which brings both opportunities and challenges. Only by steadily advancing reforms and strengthening risk management and regulatory system construction can emerging markets gain a firm foothold in the global financial wave and achieve sustainable development. I hope that today's sharing can provide you with some thought, and I also look forward to witness more successful reform cases in the future. Thank you for your listening.